rising interest rates, recession fears, stock market chaos. In the middle of all this, one REIT stood strong, quietly rewarding investors with solid income year after year. That REIT is Mapletree Industrial Trust, or MIT. In today's video, we'll uncover how MIT grew its earnings, maintained high occupancy, and still pays a stable dividend yield of over 6%, even in this volatile environment. So if you're hunting for safe passive income in uncertain times, you'll want to stay with me till the end. Disclaimer: this video is for informational and educational purposes only and does not constitute financial advice. Please do your own research or speak with a licensed advisor before making any investment decisions. Don't forget to like this video so more income investors can find it, and subscribe to Wealth for You for more insights on Singapore REITs and dividend stocks that work harder for your money. Part 1. Intro to Mapletree Industrial Trust, or MIT. Mapletree Industrial Trust, or MIT for short, is a leading Singapore-listed real estate investment trust focused on industrial and data center properties. As of March 2025, MIT owns 141 properties across Singapore, North America, and Japan. That includes high-tech buildings, business parks, and a huge slice of data centers, which now make up over 55% of its portfolio. The trust's total assets under management, a whopping 9.04 billion Singapore dollars, and its market cap stands around 6.7 billion Singapore dollars, making it one of Singapore's heavyweight REITs. Part 2. FY2024-25 Financial Highlights. Let's talk numbers. And trust me, these are the kind that income investors love to hear. Despite all the economic turbulence around the world, Mapletree Industrial Trust held its ground in FY 2024-25. While many were tightening belts, MIT quietly grew its business. First, gross revenue rose to 711.8 million Singapore dollars, up 2.1% year-on-year. That means more money coming in from rent and property income. Then, even after operating costs, net property income climbed to 531.5 million Singapore dollars, also up 2%. Solid performance in a shaky market. Now here's the part that matters most to dividend investors. Distributions to unit holders hit 386 million Singapore dollars, and DPU grew to 13.5 cents, marking a 1% increase from last year. That's not just a good year. It's a 14-year streak of sustainable growing returns since MIT's IPO back in 2010. And what's behind this resilience? A growing portfolio. MIT's total property valuation now stands at a robust 9.04 billion Singapore dollars, thanks to new acquisitions in Japan and positive rental reversions in Singapore. In a world full of volatility, MIT stayed consistent, and that's exactly what long-term investors are looking for. Part 3. Occupancy and operational strength. Now let's look beyond the numbers, because how well a REIT manages its tenants and space is just as important. MIT maintained an impressive overall occupancy rate of 91.6%. That's stability across a geographically diversified portfolio. In Singapore, occupancy held strong at 92.9%. And what's even better, rents actually improved across most property segments. In a high-interest environment, that's no small feat. Over in Japan, both the Osaka and Tokyo data centers are fully occupied, 100%. Not a single square foot sitting empty. That really shows solid demand and operational strength in the region. Now, North America did pose some challenges. There were a few lease expiries, but MIT responded fast, renewing or backfilling a large portion of the space, proving they're proactive and hands-on when it comes to managing risks. One standout stat? In Singapore alone, MIT achieved a rental reversion of plus 8.1%. That means when leases were renewed, tenants agreed to pay higher rents. That's a real-world sign that tenants see value and are willing to stay, even at higher prices. It's clear, even amid economic noise, MIT's properties continue to attract, retain, and grow value from tenants. That's operational strength in action. Part 4. Debt management and interest rate hedging. Now let's talk about the elephant in the room: interest rates. Over the past year, rising rates have caused real pain for many REITs. Borrowing costs shot up, interest expenses ballooned, and distributions took a hit. But not for Mapletree Industrial Trust. MIT navigated this storm with strategy and discipline. To start, 78.1% of its debt was locked into fixed rates, meaning the bulk of their borrowing costs didn't budge, even as rates soared. And they weren't short-sighted either. The average hedge tenor was 3.4 years, giving MIT breathing room through economic cycles. The result? While others scrambled, MIT kept its borrowing cost steady at around 3%, an impressive feat in this environment. And it wasn't just about hedging. MIT's interest coverage ratio came in at 4.3 times, a clear sign that its earnings are more than sufficient to cover its debt obligations. That's financial strength, not just on paper, but in practice. But they didn't stop there. MIT also took proactive steps to pare down debt, using proceeds from divestments, like the Tanglin Halt cluster and a data center in Georgia, to reduce their debt load. By March 2025, aggregate leverage was at a prudent 40.1%, comfortably within regulatory limits. In short, while interest rates became a wrecking ball for some REITs, MIT managed the impact with foresight, stability, and smart capital decisions. Part 5. Forward Strategy. MIT isn't just sitting still. They're proactively managing risks in their North American portfolio by engaging tenants early, backfilling leases with long-term commitments, and repositioning or divesting non-core assets. At the same time, their expansion into Japan and continued stability in Singapore provide income resilience and long-term growth. And with solar energy initiatives and green building upgrades, MIT is also aligning with sustainability trends that future-proof the business. Part 6. Why MIT is still a good dividend stock. So why does MIT still shine as a dividend stock in today's volatile market? Firstly, MIT's income is backed by essential assets. Think data centers, business parks, and industrial facilities. These are not speculative assets. They're the backbone of the digital and logistics economy. Secondly, tenant diversification is strong. Over 2,000 tenants, with no single one contributing more than 6% of total rental income. This protects investors from sudden shocks. And importantly, MIT's data center portfolio is largely on triple net leases, where the tenant pays for most operating costs. That means higher and more stable margins for unit holders. Part 7. Why now is a good time to buy? With markets uncertain and REIT prices under pressure, MIT is trading at attractive valuations, with a forward yield of over 6% based on current prices. You're getting a globally diversified portfolio, a high-quality mix of data centers and high-tech assets, solid management with a track record of delivering rising distributions, and strong risk controls on debt and leasing. If you're an income investor in Singapore looking for stability and growth, MIT deserves a spot on your radar, and maybe even in your portfolio. If you found this breakdown useful, give it a like, and share it with your fellow investors. And don't forget to subscribe to Wealth for You for more updates on Singapore dividend stocks and REITs. Do you think MIT is a buy right now? Drop your thoughts in the comments below. I'd love to hear from you. Thanks for watching, and as always, stay invested, stay informed.